If you only watch one video about day trading, make it this one, because you can follow all of the rules that the gurus teach you, the indicators, the setups, the perfect entries, and still watch your account go nowhere. After 8 years and thousands of trades, I figured out why. Day trading doesn't run on rules. It runs on a few simple laws, and once you understand them, everything clicks. So I'm gonna give you the entire pass, from literally knowing nothing to placing a real trade with a real strategy. No fluff, no hype, let's start from zero. Before you even think about strategy, before you look at a single chart, there's a step almost everyone skips, and skipping it is exactly why they stay confused for years. Here's the thing. You cannot trade a language that you cannot speak. If you don't know what is a pip, what is a leverage does, what is a spread, how a candle is even built, then every video you watch after this is a landing in nothing. It's like trying to read a book in a language you never read, never learned. That's why most beginners feel permanently lost. They skipped the alphabet and jumped straight to trying to write sentences. So step one is simple. You learn the language. And there's one free resource. That free resource teaches it even better than anything you will pay for. Go to BabyPips.com and complete the School of Pipsology. All of it. When I started, I read every single lesson at least 3 times. This is where you're gonna learn the rules the banks already know, the actual mechanics of how this market works. It's free, it's warning, and it's non-negotiable. No shortcuts. Do this first, and everything else in this video will actually make sense. Skip it, and you'll be back to square one in a month. Now that you speak the language, you need a place to fight, and how to set it up will either give you clarity or keep you drowning. Most people get this exactly backwards. Here's the trap. Beginners think the answer to being unsure is to add more. One more indicator to feel safe, one more confirmation, one more tool. But complexity is the enemy of execution. The more variables you put on your chart, the more you hesitate. The more you second guess, the slower you are when it actually counts. A cluttered chart doesn't make you a better trader. It makes you a frozen one. So your battleground is one clean chart. That's it. The tool is TradingView. It's free and it's what everyone serious uses. And it does everything you need. Set up a free TradingView account, open your chart, and here's the part that will feel wrong, but trust me, keep it clean. No stack of indicators, no 12 moving averages, a clean candlestick chart, your one time frame, and maybe a session tool later for timing. You don't need more confirmations, you need clear binary rules, which is exactly what the rest of the video is going to give you. Your charts should be so clean that when a setup appears, you see it instantly, instead of hunting for it through the noise. Okay, you've got the language and the battleground. Now, here's the single most important idea in this entire video. And if you get just this one thing right, you're ahead of 90% of the traders. Because becoming profitable really comes down to only 2 things. Think about why most people lose. It's not they don't work hard. It is that they're missing half of the equation without even realizing it. Have you ever had a situation where you enter a trade, price takes out your stop loss, and then reverses and runs right in the direction you were trading in? That's exactly what it looks like when you only had one component. You knew the direction, but you were wrong about your entry. Or it was the opposite. Your entry is perfect, price reacts beautifully off, your level holds exactly like you called it, but it never reaches your take profit and rolls over. That's when you were right about the key level where price would react, but you had no idea about the actual direction you needed to trade in. Either half alone is just gambling with extra steps. So here's the whole game stripped down. To be a profitable trader, you need exactly 2 things. You need to know where the price is going, that's the direction, and you need to know where to get in, that's your entry. Direction and entry, that's it. Every single thing I teach you for the rest of this video slots into one of those two boxes. So that's exactly how we're going to build this. First, I'm going to show you how to read the market direction, how price actually moves, and how to tell where it is likely to head it. Then I'm going to show you the entries, the only handful of ways price actually turns, so you know precisely where to get in. Get both halves working together and you stop guessing and start trading. Let's start with the direction. Because if you get this wrong, nothing else matters. So let's start with the first half, direction. Where is the price actually going? Because here's the thing, if you get the direction wrong, it doesn't matter how perfect your entry is. And most traders are guessing at this. By the end of this section, you won't be guessing anymore. Here's what nobody explains simply enough. The market, no matter how chaotic it looks, it only ever does two things. It trends and it ranges. That's it. It moves in a direction, a trend, and then it stops, goes sideways to catch its breath and build up energy. That's a range. And then it trends again, up, sideways, up, or down, sideways, down. That cycle never stops on every time frame forever. And this matters more than almost anything. Because if you can't tell which stage you are in, you will always be on the wrong side of the move. Always. Traders lose because they try to trade a breakout when the market's stuck in a range, or they wait for a range when price is already trending away from them. They are fighting the current because they never learned to read it. So let me make each stage that simple to recognize. A trend is when the price is making progress in one direction. In an uptrend, you see it stairs stepping up. Each push goes higher than the last one. And each dip stops higher than the last dip. Higher highs and higher lows. In a downtrend, it's a mirror. Lower lows and lower highs, stairs stepping down. If you can see that staircase, you are in a trend and you already know the direction. You go with the stairs, not against them. A range is when price stops making progress. It just bounces between a rough ceiling and a rough floor. No new highs, no new lows. It's coiling sideways, building up energy, trapping impatient traders on both sides. The range is the market resting, and the edges of that range, the ceiling and the floor, are exactly where the next big move launches from when price finally breaks out. So your very first read on any chart is just this one question. Is the price stair stepping in a direction, or is it just bouncing sideways in a box? Trend or a range? Answer that and you already know more than most people staring at the same chart does. Now there are actually a number of ways reading the direction of the price. And I want to be honest with you about all of them. Because you're going to hear different gurus swear by different tools. Some traders use indicators like moving averages. It's more objective, mechanical read. If the price is consistently above the 20 moving averages, you've got a strong trend. Above the 50%, it's a healthy trend. Above the 200, it's a long-term trend. Others are going to use trend lines, drawing a line along the lows or highs in an uptrend to see the direction at a glance. And those work as well, they're not wrong. But after 8 years, the best way I've found to read direction is to read the market structure directly. Those higher highs and higher lows, those lower lows and lower highs we just talked about. Why? Because indicators are always a step behind. A moving average is just an average of what already happened. Every review mirror. Market structure is price itself, life, telling you what it is doing right now. Indicators and trend lines can confirm what structure shows you, but structure is the source. Read the market structure and you're reading the market's actual intention instead of a lagging mass formula. Now, here's one nuance that will save you a lot of pain, and almost nobody says it. The trend gives you overall direction. And yes, the trend is your friend. Trading with it stacks the odds in your favor. But the direction of the trend is not the exact direction you enter your trades in. Because inside a bullish trend, price does not go straight up. It has a bullish pushes and bearish pullbacks, right? If you want to catch a clean, strong move, you use the trend for your buys. Which way to lean, and then you use the entry half of the equation to time the actual trade. Direction tells you which way to face. The entry tells you when to pull the trigger. Keep those two jobs separate and you will stop getting shaken out. So that's a direction. You read whether the market is trending or ranging. You use market structure as your primary read and you let the trend set your buys. That's the first half of the whole game handled. But a bias is useless on its own. You still need to know where to actually get in. So now let's talk about the second half, the entries. And this is where I'm going to simplify something the entry industry has made way too complicated. And real quick, if you want me to look over your charts and help you read the direction and structure properly in the real time with a feedback on your actual trades, that's exactly what we do inside the mentorship. That kind of personal review was the single thing that changed my trading. The link is going to be in the description below. Now, the entries. Now, for the second half, the entry, and I need you to hear this because it's going to save you literally years of your life. There are millions of strategies being sold to you online, thousands of gurus, endless indicators, and underneath all of them, there are only 3 ways to actually enter a trade. 3, not 50, not 10, only 3. Once you see this, you'll never be overwhelmed by a new strategy again, because you will recognize it's just one of those 3 wearing a costume. Here's why this matters so much. The reason beginners feel permanently lost is they think every guru is teaching something different. So they jump from ICT to SMC to supply and demand to order blocks to Fibonacci, chasing the one that works, never sticking with anything long enough to get good with that. But they're all reading the same chart. Every winning system ever built stands on the shoulders of one of these only 3 core entry models. When you understand that, the whole noisy industry collapses into 3 simple doors. You just pick one, master it, and ignore the rest because it's a noise. So here they are. The only 3 ways price actually turns: the breakout and retest, supply and demand, and the liquidity grab. That's it. That's the entire menu. Every secret strategy you've ever been sold is one of these 3. And here's the key idea most people miss. Each one works best in a different market conditions. Remember what we said about the direction. The market trends and it ranges. Well, different entries are built for the different market stages. So let me break down all 3, what each one actually is and when to use it. This is most straightforward of all the 3. And honestly, what I would tell most beginners to start, a breakout and retest is exactly what it sounds like. Price is sitting in the range, that sideways box we talked about, like building up energy. Then it breaks out of that box with force. But here's the part amateurs get wrong. You don't chase the breakout candle. You wait. Because the real breakout will usually come back to retest the level it just broke out. Like price is shaking your hand to confirm the level flipped. And that retest is your entry. Remember the 2 stages of the market from the start of this video: price trends and price ranges. Here's the key. That range will not last forever. At some point, it bursts. It releases with a new power in one of the directions. And this model is designed to catch exactly that. This model shines when the market is transitioning out of the range into a trend. That moment the energy releases. It is built to catch the transition phase, price flipping from the rangy stage into the trendy stage. That's why it's a backbone of the ARB strategy, the opening range breakout, and the strategy I personally trade. When a session opens and price finally breaks the range it built overnight. Breakout and retest catch that explosive move right as it begins. If you're a day trader with a limited time, this is the cleanest, most mechanical of all of the 3. The whole game with a breakout is identifying the range, the right range to break out of. That's a 90% of your success. And the secret to making it mechanical, which we will go deeper later on this video, that is tying that range to a specific time of the day so it's the same for everyone without guessing. Then you're gonna wait for the full body breakout, wait for the retest, and enter the trade. Stop goes beyond the range and you aim for a solid 3 to 5 hour trade. Supply and demand is the oldest method in all of trading, and it's a beautiful because it's just a basic economics on the chart. A demand zone is the price level where buyers are so aggressive. They overwhelm sellers and price rocks up. So when the price returns to that zone, buyers tend to step in again. A supply zone is the opposite, a level where sellers dominate and price drops hard. So when the price comes back up to that level, sellers reload. You're not guessing, you're marking the exact areas where the big money has already shown its hand. In trading the reaction when price revisits them. This one works best in arranging or reversing market conditions, when the price is bouncing between levels rather than trending hard. It is how you catch the turn at the edge of the range, or a reversal of a major zone, where the breakout and retest catch the release of the energy. Supply and demand catches the rejections at those levels. But here's where almost everyone destroys themselves with supply and demand, and where I'm going to save you. Stop doing multi-timeframe analysis. The single biggest scam you have been convinced is that the higher timeframe levels are stronger than the lower timeframe ones. So you mark up the daily and try to trade it on the 15-minute timeframe. Don't. Stick to one time frame based on the trader type you are. 15-minute is for the day traders. And find all of your levels there. Second, older does not mean stronger. Traders are going to clutter their charts with dozens of ancient levels that price stopped caring about for a long time ago. Only mark levels by their relevance. For a day trader, that's a previous day's candle. Anything older than that is just a noise. Price doesn't relate to that anymore. Clean chart, one time frame, one relevant zone. That alone puts you ahead of 90%, 95% of supply and demand traders. This is the most advanced of three, and honestly the most eye-opening ones you've ever saw. A liquidity grab is when price deliberately pushes past an obvious level, an obvious high or low where everyone's stop losses are sitting, grabs all of that liquidity by triggering those stops, and then sharply reverses the other way. It looks like a breakout, it traps everyone who chased it, and then it does the opposite. Once you can see liquidity grabs, you stop being the one getting trapped and start trading with a move that traps everyone else. This works best around the key highs and lows of a sessions or a day. The obvious levels where retail stops pile up. It is the model that explains why you keep getting stopped out right before price goes in your way. You were the liquidity. Trading the grab means waiting for that stop hunt to happen. Then entering on the reversal. You mark the obvious liquidity, the clear session high or low that everyone can see. You wait for the price to sweep beyond it and fail. A sharp push through followed by an immediate rejection back inside. That failure is your signal. Then you enter on the reversal with just your stop loss just beyond that week or of a sweep. It takes it just a little bit screen reading more than other two, which is why I would master breakout and retest first. But once you understand liquidity, you understand why other two models work in the first place. Now, whatever of these three models you're trading, you still need a precise trigger to actually pull the trigger, an exact price to enter, not a vague somewhere around here. And this is where I want to steer you away from what the SMC crowd teaches. Stop using auto blocks or the fair value gaps for your entries. You will get a brutally low win rate because the zones are huge and vague. Instead, use the Fibonacci levels for your sniper entries. Once your model gives you a valid move, a breakout leg, or a rejection of a zone, a reversal of the liquidity sweep, you draw your Fib level on that impulse move and enter on the golden zone, the 60 to 80% retracement level. Enter around 60 to 70% for strong trends and 70 to 80% for the weaker pullbacks. Your stop loss is going to sit safely beyond the zone above the 80% if you have entered at the 60%. Precise entries, genuinely safer stops, and you're always trading with a structure instead of guessing where the level is. So now you've got the both halves of the game: direction, the trend, range, and structure. An entry, the three models, and the Fib trigger. To time them, Honestly, that's more of a real trading education than most people get after spending thousands on courses. But this is a part that nobody wants to hear. None of these will ever make you a single dollar until you understand something deeper about how trading actually works. Because you can have the perfect strategy and still lose. So before I give you my exact strategy, we need to talk about the things that separates the traders who make it from the one who quit. Okay. Now you have a real strategy education, direction and entries. So why do I keep telling you that none of it will work, will make you money yet? Because there's the truth about trading itself that's more important than any strategy. And misunderstanding it is the reason why 90% of the people fail even when they're handed a working method. Let me fix that right now. Here's the thing you have to accept. And it's uncomfortable at first. There is no holy grail. There is no strategy on earth that wins every time. And any guru selling you a 90% win rate, never lose system is lying to you. The moment you understand that, you stop looking for the perfect strategy because you realize the perfect strategy was never the point. Because trading is not about predicting. Trading is about probability game. Let me make this crystal clear. You cannot know the outcome of any single trade. Not one. I've been doing this for 8 years and I can't tell you if my next trade is going to be a winner or a loser, and nobody can. A single trade is just like a coin flip. And this is everything. Across a large enough sample of trades, a real edge plays out exactly as the math says it will. You cannot predict the one, you can absolutely predict 100. That shift from obsessing over the next trade to trusting this sample is the single line that separates gamblers from professionals. So what do you actually do with that? You stop judging your strategy by any single trade or any single day. A loss is not a sign that your strategy is broken. It's just one coin flip landing tails, which was always going to happen sometimes. Your job stops being win this trade and becomes execute my plan the same way over and over. And let the math do the work. When you internalize this, losses stop hurting the way they used to. They become a normal expected cost of doing a business, not a personal failure that sends you back to YouTube looking for a new strategy. And this leads directly to the most expensive mistake in all of the trading. The one that's quietly keeping you broke even if everything else was right. Let me ask you something. Honestly, how many losses in a row before you quit a strategy? 3? 5? Be honest about that, because whatever the number is, it's the reason you're not profitable yet. Here's the uncomfortable truth. You cannot judge your edge until you've taken 100 trades. Not 10, not 20, 100. A strategy is not proven in a week or a month. Just like a business doesn't turn a profit on a day one, your edge needs enough trades behind it before the results mean anything at all. And the math is working against your patience. If you're a day trader taking 1 or 2 trades a day, it can take you the better part of a year just to forward test the strategy properly. Most people quit in a month or 2. They abandon the marathon at the first mile. And here's what makes it so tragic. Switching strategies is not progress. It's starting over. Every single time you abandon the method and jump to a new one, you reset the clock. You go back to 0 trades, 0 data, the 0 age. If you keep starting again, you will never reach 100 trades on anything, which means you will never find out if any of it works. You'll spend years in motion and go nowhere. Remember, almost every strategy rates the same price action. Anyway, trend, Fibonacci, supply and demand, they're all looking at the same chart through different lenses. The strategy is rarely the problem. The trader who quits a trade 20 is. So here's what you actually do. You pick one method, ideally the mechanical one I'm about to give you, and you commit to running it 100 times before you judge it. Not before you tweak it, not before you quit it. 100 trades. You keep a simple record so you're building a real data instead of relying on feelings. And when the doubt creeps in and after a week of a losing streak, because it will, You recognize it for what it is. Doubt is what kills trading careers, not bad strategies. You don't quit because the strategy stopped working. You quit because you stopped believing in it during a completely normal losing streak. Name that feeling when it shows up and don't let it make your decision. Quick pause. If this is a first video that's actually laid the whole thing out for you in order, do me a favor, hit a like and subscribe. That's genuinely how this channel reached the next trader who is stuck exactly where you are. It costs you 2 seconds and it helps me more than you know. Okay, let me tie everything together and give you the one thing that actually turns all of this into an actual system. You've got the direction, you've got the entries, you understand it's a probability game and you have to run 100 times. And yet, I'm telling you that there's still one missing piece. The piece that turns everything you've learned from a bunch of concepts into a system. You can actually run it in 15 minutes a day, half of sleep, after work. This is a secret, and once you see it, you cannot unsee it. Here's the problem with everything I've taught you so far. It is still a little bit subjective. Think about it. If I put you and another trader in front of the same chart and let's say mark a range or find a supply zone, you will mark slightly different things. Your trend rate might differ from his, and that little bit of subjectivity, that's exact crack where fatigue, emotions, and second guessing pour in, especially at 6 p.m. when your willpower is gone, or 8 a.m. when you're not woken up properly. None of these strategies will work for you until you make them 100% mechanical. So rule-based that even your grandma could follow them and make profits. No interpretation, no it depends, no judgment calls. But here's the question nobody answers. How do you actually make a strategy mechanical? You can say, be objective all day. But how? And the answer is so beautiful in how simple it is. The only way to make a strategy truly mechanical is to introduce the time element into your trading. Let me show you why this is so genius. Everything else on the chart is open to interpretations, but time, it is not. 9:30 is 9:30 for you, for me, for everyone on this earth. The first 4 hours of a session are the same for 4 hours of the session for everyone. So the moment you anchor your setup to a specific time, all the subjectivity vanishes. You and that other trader will now mark the exact same range because you're both marking up the same exact window, not your opinion of whether the range is. Time is one thing on the chart that cannot be argued with. It is the anchor that makes everything else subjective. And that single idea, tying the strategy to the time, is what turns all of the theory in this video into the exact strategy I'm about to give you. This is it. This is a strategy that takes everything you've learned, direction, the breakout and retest entry, the probability mindset, and the time element, and fuses it into one clean mechanical 15 minutes a day system. It's called ARB. And it's what I personally trade every single day. You've probably heard of the ORB, the opening range breakout. It is hyped everywhere right now, and for a good reason. The concept works, but it has one drawback nobody talks about. It's a scalping strategy on the 1 minute chart during the most volatile 30 minutes of the day. That means hours of intense screen time, split-second decision under the pressure, and the total mental burnout before your edge even gets a chance to play out. There had to be a better way. So I built the one. The ARB takes the exact same core principles as the ORB, same breakout and retest logic, same mechanical concept, but applies them on the 15-minute time frame, using the first 4 hours of the Tokyo session as the reference range. Instead of scalping a tiny window on the 1 minute chart, you're trading the 4-hour range on the 15-minute chart. Same edge, far less screen time, far less fatigue, far more clarity. on every setup. And here's why the timing is so beautiful. The Asian session is the quietest period of the entire trading day. For those 4 hours, price consolidates and builds up liquidity with almost no big institutional players involved. The market is asleep, coiling up. The London opens and everything changes. Institutional volume floods in, volatility explodes, and price breaks out of the range it spent all night building up. Remember the two stages, range and the burst into the trend. The Asian session is the range. London is the burst. By marking the first 4 hours of the Tokyo, you position yourself perfectly to catch the explosive move. The exact moment it begins. Here's exactly how you run it. You have to mark up the range every morning before the London opens. Use the sessions indicator to identify the first 4 hours of the Tokyo session. Draw the high and the low of that window. That range is your reference point for the whole day. Everything inside is just a consolidation. Ignore it. Everything that breaks out of that during the London or New York is a potential trade. Wait for the breakout, then for the retest. When the price breaks out of the Asian range during the London or New York, you don't chase the breakout candle. You wait for the price to come back and retest the level, the handshake that confirms it. Enter with a Fibonacci level, draw your Fibonacci on the breakout leg and wait for the price to pull back into the golden zone. Enter at the 60% level, place your stop loss just below 80% level and target for a minimum of the 5R. One setup per session, execute it cleanly and close the charts. That last part is the whole point. One clean mechanical trade based on a rule anchored time. And then you walk away and live your life. No staring at 1 minute chart, no burnout, no guessing. That's what trading looks like when everything in this video comes together. And wrap it up in the risk rule that keeps you in the game. Risk a fixed 1% per trade, set your stop loss before you enter, aim for realistic 3 to 5 hour targets, not a fantasy like 20 hour hero trades, and never decrease your risk during a losing streak. Fixed risk, mechanical entries, run it 100 times and trust the sample. Before you take any trade, run these 5 questions. If the answer to all 5 is not yes, you don't have a trade. Am I trading my one time frame, the 15 minute? Is this one of the 3 core entry models, breakout and retest, supply and demand, or a liquidity grab? Is it my session, the London or the New York Open? Is my risk fixed at 1% with my stop set before entry? Is my target a realistic 3 to 5 hour drawn from a real Fib entry? 5 yeses, you take it. Anything less, you wait. That checklist alone will make you more disciplined than 95% of traders. And before we finalize it, let's break down a couple of real-life examples with the ARB strategy. Okay, folks, this is a real-life examples of this strategy. First of all, that you have to understand, we are on a 15-minute time frame on Euro USD. These vertical lines identify the breaks of the day. Basically, this is when the new Tokyo session opens. So basically, you open the charts right before the London and New York sessions. Like sometimes it happens during the London session, sometimes it happens during the New York session. For me, it is convenient to trade the both sessions. So I open my charts right before the London session, and we have to draw the high and the low of the price action during the first 4 hours of the Tokyo session. For that, I use the Fib levels. By the way, you can copy my settings over here. Here are the settings. You see, it's just going to, and I've added these text over here. But in any way, as you can see over here, the price is breaking to the downside and retesting our Asian range. This is where we just need to get our Fib levels, draw it from the high to the low of the breakout, and let's apply it. And we are going to enter our trade at the golden zone. So basically, this is a secret that we teach inside of our mentorship program, but let me share it with you. Basically, you can enter on the golden zone, which is 60, 70, and 80% retracement levels. By the way, this is the settings for my Fib levels as well. What I would recommend for the beginner traders is to divide your trades. For example, you're risking 1%, so you have to risk 0.3% on all of
on each of 3 levels, on the 60%, on the 70%, and on the 80%. And the stop loss is going to go above this Asian high. Basically, with this way, you can aim for 5R, but sometimes the price can give like 10R trades as well. Let's cover a couple of more examples. Here's another example, and it is a little bit more interesting than the previous one. Let's draw the high and the low of the price action. Let's mark up our Asian range. First, as you can see over here, the price is breaking to the upside. We are getting the confirmed the breakout. But the most interesting part is that we are doing that before the London session. And by the way, this vertical green stripe represents the first 2 hours of the London session, and this pink stripe represents the first 2 hours of the New York session. So basically, the price is just doing some manipulation above the Asian high before the London session. And during the London session, the price is just ranging inside of the Asian range, and right before the New York session, we are breaking to the downside, and then price is going to retest our Asian range. Basically, what we do here is we draw our Fib levels from this high, from the sweep, from the high of the sweep to the bottom of the breakout, and then we are placing our trade at the 60% retracement level, and the stop loss for the 60% entry is going to go above 80%. And as you can see over here, the same, like with this trade, we can aim for 5R as well, and the 5R, the price gave us 5R only the next day. So basically, the lesson that you need to take from this trade is that you don't take the trades that happen before the London session. So everything that happens after the London session is valid. And when you will be trading, when you will be drawing your Fib levels, you have to do it not from the high of the Asian range, but from the high of the sweep that happened prior to the real breakout. So let's move further and just cover a couple of more examples. So here is our Asian range. This is Asian low. This is our Asian high. And as you can see over here, the price is breaking out to the upside during the London session, and it is retesting our Asian range during the New York session. For those who tell like I'm from US, I cannot trade this strategy. No, you can. We do have trades during the New York session as well. And by the way, guys, this is just one of the 4 methods that we trade. We do have OP method number 2, 3, 4. This one is called OP method number 1. So basically what we do, we draw our Fib levels from the bottom to the upside, and we enter our trade at the 60%, and let's say this was our trade. It gave us 5R, but if you say that the price is almost at the 80%, we could have entered at the 80% as well, and this would have give us 5R trade as well. So doesn't matter. Or you can just divide your trades into 3: one on the 60%, one on the 70%, and one on the 80%, and aim for 5R from the best case scenario trade. Let's cover one more example. This is more unusual example when we do have losses with this strategy as well. For example, what is happening here? The price is sweeping the Asian low, then we're having the breakout to the upside during the London session, and the price is retesting our Asian range during the London session, and we are getting stopped out here from one trade. But guys, we are breaking to the downside. As you can see over here, it is a confirmed breakout. One candle is breaking down, another candle confirming the breakout. So basically, we can trade the OP method number 1, the breakout trade, to the downside from here. We have a successful breakout to the downside, the entry at the 60%, the stop loss goes above 80%, and we will be aiming for, in this case, guys, the price didn't give us quite like 5R trade. So this trade, probably this would have ended up being the break-even trade, or like aiming for 4R is pretty good as well. So basically you can aim something around like 3 to 5R with this trading strategy. And why this strategy is so mechanical? Because you can trade the OP method number 1 only one time per one side. For example, we can trade those number one to the upside one time, and we can trade OPMS number one to the downside one time only and only. So basically, let's say we do have one like bad trade over here. The price broke to the upside. We will not be trading the second breakout. So basically, if you open the charts and if you see that the OPMS number one already played out or failed to play it out, that means that you don't have to look at the charts anymore that day, at least for the OPMS number one trade. So this is a beauty of OP methods that makes them 100% mechanical. Okay, let's cover this example and we can wrap it up. Okay guys, look, here's our Asian high, this is our Asian low, and over here the price is breaking out. We do have one full body candle that broke to the downside, one more candle closing outside of our Asian range. Basically what we do here is that we draw our Fib levels from this high to this low, and we enter our trade. Like, we enter our trade as usual at the 60% retracement level. The stop loss goes above the 80% retracement levels, and we will be aiming for 5. But as I said, sometimes price can give us like 10-hour or like 15-hour trades as well. But this is more kind of like the exclusions. Like, most of the times we are going to get 5-hour trades with this method.
So let's bring the entire thing home. You came in maybe knowing nothing, and now you have the whole pass. You learned the language on the BabyPips.com. You set the clean battleground on the TradingView. You learned the two things that actually matter: direction and entry. You learned how to read the market's direction through the structure and the only 3 ways price ever turns. You understand the deepest truth in trading, that it's a probability game. You win across 100 trades, not one. And you learn the secret that ties it all together. Make it mechanical by anchoring it to the time. Then I handed you the exact strategy that does all of it, the ARB strategy. That is genuinely more than most traders piece together in their first few years. You got it in a one video. Now here's the only thing left. Knowing the past and walking it are two different things. If you want me to walk it with you, the full ARB setup, the sessions indicator, the exact rules, live examples, and me helping you tailor it to your own schedule, I've left the first link in the description below how I can help you do that. I will see you inside.